All right. As promised, we get to do accounting today, chapter 1. And as I mentioned before, the first 3 chapters are reviews, so we will start and probably finish chapter 1 today because it is review. It's all actually review. Well, there's a tiny bit new, but there's the column format that we introduced in Accounting 100 that we will only be using in chapter 1. So there is a slight change, but it will not really affect much until we get to chapter 11. But it will affect a little bit. Hopefully you were able to get the outline. Again, the outlines are your study guides. Everything that you will or could be tested on will be on the outlines. Not on the outline, I won't test you on it. Very helpful. And again, I have all of the forms and everything that we're going to be working on today already set up for you, so we can just enter the data. So just a bit of an overview, and the one, well, kind of, not a minor change until later in the semester, but types of business, very similar to what we did in Accounting 100. We will start out as a service business in chapters 1 through 3, where we will be selling services, most often consulting or business consulting or tax preparation, although there are a lot of different service industries. And then in chapter 4 on, we will be a merchandising business, so we will switch to selling merchandise, which, as you remember from Accounting 100, involves more transactions, more things to keep track of, and inventory and all that fun stuff. But the way we're going to do it in this class is quite a bit more efficient than the way we did it before. So now you have this accounting cliffhanger, and now we got to wait till chapter 4 to figure out what that is, but that will come quick enough. And then we will be a merchandising business throughout the rest of this class. And then manufacturing, which our business is buying all the individual parts and making and selling the finished product. This is Accounting 102. So that is just an overview, not really anything new just yet. Question? Could be. It should be Wi-Fi. I don't know. Anyone have any information on that? It's not. Yeah. Oh. That I don't have any detail. I know that they have been working on that for a few semesters, and it has come up in many meetings that I've been on, with students complaining about it, faculty complaining about it, and they keep insisting that they're fixing it, but it doesn't seem to be getting any better. So thank you for letting me know that, because I had somebody yesterday asking about the Wi-Fi too. So I will bring that up yet again at the meetings that where people are there that have something to do with that, because yeah, it's an issue. And I know there's a couple, and I'm not even sure which one you're supposed to use. There's an event and WPA or something. I'm not sure. You can try that. Try your regular log on to the Cerritos College stuff into the portal, and that might get you on. I'm not sure though. So types of businesses. And then this is where the change is in Accounting 101 versus 100, because these are the 3 primary types of business ownership. And usually, if you're not the accountant, this doesn't really matter. You don't usually ask when you go to buy a service or a product or food from a particular company, yes, how are you organized? Are you proprietorship, partnership? Or usually that doesn't come up. If you get good service, you like the product, you are okay with the price, then And I have to say okay with the price because nobody really likes the pricing these days, but we just kind of okay with it. So it doesn't really come up, but since we are on the inside of it, we're doing the accounting, and we need to know because it will affect what our equity section looks like, and it will affect what tax returns we file, and it also affects some of the laws about which taxes we pay, among other legal issues revolving around the type of ownership. So in Accounting 100, this is what we did. A proprietorship or sole proprietor means it is one owner. And if you remember, our equity account for a proprietor, the proprietor was the owner's name in capital and the owner's name and drawing. Right? So in Accounting 100, we had the capital account and the drawing account. Money into the business. This is where we closed all of the accounts at the end. All of the earned and invested equity went into the capital account. And then money paid out that the owner paid out of the business to him or herself came out of drawing. But it was also increased to capital when money went in, decreased to capital when it went out. So this was our equity accounts in a sole proprietor. If we are a partnership is two or more people. It can be two, it can be three, it can be hundreds. It just matters of some legalities as far as who can and can't be a partnership or corporation and stuff. So the largest accounting firms, the 4 largest accounting firms are partnerships. Law firms are usually partnerships. That's why there's all their names on the name of the partnership, because there are some legal requirements that certain professions cannot be corporations because a corporation can relieve personal responsibility. So when you have professions like doctors or lawyers or accountants, you want those people to have some personal responsibility to ensure that they are doing a good job. Like, oh, well, I don't care. It doesn't matter if I do a good job. Sue me. It's not me anyway. It's a corporation. You don't want that attitude. Yeah, nobody should have that attitude, but especially for certain professions. So partnership is 2 or more. And then if we have 2 partners, there would be 2 capital accounts and 2 drawing accounts. If we had 10 partners, there'd be 10 capital accounts and 10 drawing accounts. So, but then there is the corporation. This is what we are starting now, starting right this moment for the rest of the semester. Our business form of ownership is a corporation. That does not affect the day-to-day operations. It does not affect our journal entries. It does not affect how we conduct business or what financial well, it does have. We're just going to rename a couple things, but we still have financial statements. The rules still apply. It's still GAAP, all that stuff. We will file a different tax return, which is a different class. So we don't have to worry about that. And there are different legal issues between the 3 different types of ownerships. But what we need to know is just what our equity section will look like. And once we get to chapter 11, which is going to be in December, because that's the last chapter we're going to cover, then we'll get down into the specifics of the equity section of a corporation. But until then, we just have different names for our equity accounts. So this was sole proprietor, and now as a corporation, this capital account was invested and earned equity. And that's important because this is what the owner started the business, took money out of his personal account, invested it into the capital as the business account. And then all the net incomes, remember back in closing entries, all the net incomes got closed to capital. So this was earned and invested equity. Well, we're going to split that out and make that 2 different accounts. So the earned will be separate from the invested. So we're going to call the invested equity will be common stock, because ownership of a corporation is broken up into shares of stock. Corporations can have 1 owner. They can have thousands of owners. The size of the business as far as revenues and number of locations and years in business isn't necessarily the determination of type of ownership. because you can have a corporation with one stockholder. It's more the legal issues between the types of ownership. So the invested equity goes into common stock because now the corporation is a separate legal entity. We, in a sole proprietor, we just open two bank accounts. We have a personal, one for our personal finances and one for our business finances. Same person's name on both accounts. Same bank, no issues. A corporation is a separate legal entity. It's like an intangible person. It has its own rules, its own laws, its own tax return, its own tax rates. Everything is separate from the owner. So it has to be treated. So it's a transaction as opposed to a transfer. This is transferring money from personal to business. This is, the corporation sold stock to the individual and the individual purchased stock from the corporation. So it's a completely separate transaction. And then the earned equity is going to go to an account called retained earnings. So we just took, both of them were in the capital account previously, invested and earned. Now the invested goes into common stock, earned goes into retained earnings. So we have two separate equity accounts for the invested equity versus the earned equity. And then the drawing was money paid out. Well, we're still going to do that. The corporation will still earn revenue. What it does not retain into the business as equity will be paid out to the owners, and that is called dividends. So just a name change. Money paid out of the company to the owners, money paid out of the company to the owners. Just name change. So now we will have 3 accounts in our equity section, actually 2 accounts in the equity, 3 equity accounts, 2 on the balance sheet. We cannot acquire retained earnings. It has to be developed over time. Brand new companies will have 0 retained earnings because they haven't done anything yet. We can have invested equity, but we have to earn and accumulate the earned equity. And we will, and again, at this point until chapter 11, this is really not going to come into play except for the name change. How it works is still the same. All the other day-to-day transactions still the same. Everything else is the same, except our equity section of our balance sheet. So that is the one change from 100 to 101 that will affect chapter 1. This is more of a marketing issue, which you will encounter as you take any sort of business management or business or marketing classes. Just different focuses on what we want our business to be, what we want our reputation or our primary marketing of our company to be. We can talk about that later. Business stakeholders. This is not a typo. It's not supposed to be stockholders. This is who we are preparing the information for. Anyone who has a financial stake or interest in our business, which is everyone. Of course, the owners have a financial stake in the business because they've invested their money in the business and kind of want a return on that investment. Employees have a financial stake in the business because they get paid from the business and they want the business to continue operating so they continue to have a job. Customers have a financial interest in the company because if they like our products, they're buying our products and they want us to keep selling the products so they can buy them. So they have a financial interest. Creditors have a financial interest in our business because we're buying from them, which keeps them in business, and we need to pay them, which they hope that we continue doing. So that's a financial interest in our company. Potential investors, the IRS, that's who we're preparing the information for. Everyone who has a financial interest in the business. If we are a public corporation, we have to make all of our financial information available to the public. Public corporation just means anyone can buy and sell their stock. Private corporations mean the current stockholders get to say who can and can't buy their stock. In-N-Out is a private corporation. It's a public establishment, but the ownership is private because you can't just say, oh, I want to buy some In-N-Out stock, because if you could, I would have already, but you can't because the current stockholders get to say who can and can't buy their stock. They are not publicly traded. But other corporations are. You can buy stock in McDonald's, you can buy stock in Burger King. Which one is it? Taco Bell? Who's Taco Bell with? Taco Bell's if the corporation is Yum Brands, and there's another restaurant with Taco Bell. Is it Carl's Jr.? No, that's Hardee's. Hardee's and Green Burrito. In the Western states, it's Carl's Jr. and Green Burrito, but when you get into the Midwest and the East Coast, it's Hardee's and Red Burrito. But Hardee's and Carl's Jr. are pretty. Anyway. I know McDonald's is their own corporation. Is Burger King? I don't know if Burger King is or not. What one's Burger King? Not the King. So that's who we're preparing the information for. This is an important issue, always has been, but more so lately, because when people do things they're not supposed to do and it makes the news, then everybody has to make all special rules to remind people how to be ethical. And that is not actually the purpose of the increase in the ethics education and class requirements that they do, because I don't know that someone that would be completely unethical and take a class and say, oh, I see the light now, I'm going to be ethical from now on. That's usually not how it. But for those of us who are ethical, we can't think like that. Okay? We need to know, as we're doing the accounting or we're doing the taxes or we're doing the auditing, we need to know what to look for if there are people within the company that are behaving unethically. And usually you don't even think of that. So that's what the business ethics education is for, is this is what people have done in the past. This is what you need to be aware of and on the lookout for, and watch for these different signs and these different behaviors and these different transactions and these different patterns within the financial records that could indicate something isn't right and that maybe we need to look for it a little deeper. Because if you don't have that mindset, you're not going to be thinking that that's even something that people would consider doing. It's like if you asked me today, well, how do you launder money? I'm like, I don't know. I wouldn't ever do it, and I don't. I know what it is, but and then you hear about these things, intricate transfers of money and all around, or watch the Ben Affleck accountant movie or what. I was like, all the shell corporations and hiding money, and I'm like, I don't. But that we need to know so that we can. This has that suspicious kind of pattern to it. Maybe I better look into this more. We could find out it's nothing, or could find out oh yeah, this isn't good. But unless we know what we're looking for, that's why. So there are requirements as far as becoming a certified public accountant. You have to have at least 10 units of business ethics education, and then to renew your license every 2 years. Once you get your certified public accountant license, we have to do 80 hours of continuing education, and 4 of those have to be business ethics. And again, they're not accusing all of us of being unethical, and they're trying to remind us that we shouldn't be. It's okay, here's some new things, because I'm sure that, all of the texts that we get and emails we get of I just got one this morning from UPS, air quotes, your package has been delayed. Click this link to verify your information so you can get the package. And I'm like, no, I don't think I'll be doing that. For one thing, I'm not expecting a package. And yeah, that's because there's always these different scams and stuff we need to know. And then people will post it. Oh, be careful of this scam. Be careful of that. The IRS will not call you. They're going to send you a letter. If somebody calls and says from the IRS, don't tell them anything. It's a scam. Who thinks of this stuff? So that's why, because we are dealing with other people's money, and that is a very sensitive topic. So we need to also make sure that we are doing that within all of the laws and identifying things that we see that aren't quite right, so that what we are reporting is as accurate as possible. So we have a 4-unit class for business accounting ethics, and then there's also other business ethics courses, which, how do people think of this stuff? I don't know. If only they'd use their powers for good instead of evil, we wouldn't have to deal with all of this. But such is human nature. We will be following GAAP, which is, that's a part of it. So generally accepted accounting principles, that is the rules. Our fundamental accounting equation, same 5 categories. What are the 5 categories? Does not matter the form of ownership. Every company, no matter what they do, which industry they're in, what their legal form of ownership is, what their business strategy is, doesn't matter. Every single company has the same 5 categories: assets, liabilities, equity, revenue, and expense. Always 5, only 5, same 5, never more, never less, never different names. Those are the names. You may see stockholders' equity or owner's equity, but it's equity. The accounts within the categories can change, because that's how we tailor the business to our type of business or ownership. Because now, instead of capital and drawing, our equity accounts will be common stock, retained earnings, and dividends. But it's still equity. So same 5 categories. And we add the equal sign and the plus sign. That is our fundamental accounting equation. Everything that we will do is based on that equation, and it should be in balance at all times. And under the equity umbrella here, why there's only 3 categories here is because as revenue goes up, equity goes up. As expenses go up, equity goes down. So these 2 are under this equity umbrella. The common stock will be the invested equity. The difference of these 2 will be the earned equity. So the invested is the common stock. The net of these 2 will be the retained earnings. So a quick review of first part of Accounting 100, all the rules. We'll get into this in a moment. But to refresh our memory, let's go back to put some numbers into this process. And explain it as we go. Exercise 115, which is on page 29. So Ming Cheng started a business and had the following transactions in June. So it says create the following table, which is what is in the outline already. And notice the date is important. This is June of 2023, which I don't know if it says that in there, but I just put the dates in there because remember, anything that goes into this revenue column has to actually be earned during this time period. Anything we put in the expense column has to actually be used during this time period. And here's our accounting equation: assets equals liabilities plus equity. Here are the three new equity accounts: common stock for the invested equity, retained earnings for the earned equity, and then dividends for the amounts paid out to the owners. I put this account in here, but there should never be any transactions in this account. We will not update retained earnings directly till Chapter 11. We will update retained earnings for certain transactions, but this is the closing entries. This was Chapter 3. So our equity is plus the common stock, plus retained earnings, minus dividends. And then plus revenue, as revenue goes up, equity goes up, and minus expenses, as expenses go up, equity goes down. And so to stay in balance and always stay in balance, we just follow the money around and read the transactions, what accounts are affected by how much, increase, decrease, and document it, making sure the accounting equation stays in balance. And it will tell us the transaction, and we just have to update the accounts that are affected. If the owner invested $60,000 in cash and $15,000 of equipment, notice it doesn't say in the business like it did before for sole proprietor. It says in exchange for its common stock, because now the company is a corporation. It is completely separate from the owner. It has to be a transaction and an exchange as opposed to just a transfer of money. So what accounts are affected? Well, what did the company get? We got $60,000 in cash. The company got $15,000 of equipment. So what is the total amount of stock that the stockholder received?
75,000.
75,000. It did not say that. How do we know? Yeah, because this equation has to balance. If we know that 60,000 of cash and 15,000 of assets were received by the business, we don't have to pay it back. It doesn't say that it was loaned to us, and it did not say that we earned it, so it is an investment, and the accounting equation has to balance. So that will end up being, as we will see in later chapters, I will remind you this as well, plug in what you know, make it balance. The company paid $1,500 cash for rent for the office space for the month. And again, the rule is it has to be all used in the current month listed here, or it's not an expense, all or nothing. But it says all for the month. So does that qualify for an expense? Because it says it is for the month. So we're going to say, all right, we have $1,500 of rent. And we paid cash, so $1,500 in cash. Are we in balance? It's a plus on one side and a minus on the other side. Did we stay in balance? Yes, because this decreased assets, this increase in expenses decreased equity. So we increased assets, decreased assets, decreased equity. So we stay in balance. The company purchased 10,000 of the additional equipment on credit, and the amount is due within 30 days. What accounts are affected? Well, if we bought 10,000 of equipment, we have plus 10,000 of equipment. Oh, that's common stock. That's equipment. That's not equipment. But how do we pay for it? We didn't pay cash. We're not going to decrease cash. We have to pay for it later, which means we owe the money, which is a liability, and that is the accounts payable liability. We have to pay it later. Accounts receivable asset, we're going to receive it later. The company completed work for a client and immediately collected 2,500 cash. Well, if we got 2,500 cash, right, we're going to put plus 2,500 cash. But what was that for? Why did they pay us $2,500? If we completed work, that means we earned it. So that is revenue. Again, assets increased, and the increase in revenue is increased equity, so our equation stays in balance. Top of the next page, we completed work for a client and sent a bill for $8,000 to be received within 30 days. Well, that means completed the work, we earned it, right? Because it says we already did it, so that's revenue. We're going to put plus 8,000 here. But we didn't get the cash yet. It says they're going to pay us later within 30 days, which is, it's also an asset, but it's accounts receivable, not cash, because now we have to keep track of that so we don't forget to collect it. We need to remember we need to pay this, and we need to remember we need to collect this. And I don't know about you, but I just need to write stuff like that down. And if it's our own accounts, we can do it if we want. If it's our own personal finances, I'll just try to remember or make a note to myself or set an alert on my phone. Don't forget to pay this bill on this date. But if it is for a company, it's not just us that we have to answer to. So we have to make sure that we make sure and document everything and have lists of everything we own and owe and where the money came from and where it went and all stuff. So that's what we are doing. That's what accounting is following the money around and knowing where every dollar came from and where every dollar went. Company purchased additional equipment. My goodness, what business do we have? We need so much equipment. For 6,000 cash. We have bought more equipment. We're going to add more on there. And how did we pay for it? Because we paid now we didn't do anything to the right side of the equation. Do we still stay in balance? We did, because the net effect on the left side is 0. Right side, nothing happened, so 0. We just exchanged one asset for another, so we still stay in balance, and that has to be every time built-in check figure for every transaction because it has to stay in balance. Left side of the equal sign has to equal the right side of the equal sign at all times. The company paid an assistant $3,000 cash as wages for the month. Well, if we paid $3,000, we're going to say minus $3,000. And what for? Well, we paid the employee for their time, for the work that they did for us during the month, so that is an expense. So we're going to put this is wages. Expenses are generally stuff that we use, and if we want to have the benefit from it again later, we have to pay for it again later. Equipment, well, we buy it once and then we can just keep using it. So it's not an expense yet. Using it will be an expense later, but buying the equipment is not an expense right now because it's not going to get used all up in June, so it goes in the assets. But the $3,000 we paid the employee in June is only for June. If she comes back and helps us in July, we can't say, oh, well, we paid you last month. I'm not going to pay you again this month. Well, that's not how it works. If she works more hours in July, we have to pay her again because for the hours she worked in July, we have to pay the rent again. This is only for 1 month. It's going to be all used up at the end of June. If we want to be there in July, we've got to pay again. Expenses. We collected $5,000 cash as partial payment for the amount owed from transaction E. Transaction E says this customer owes us $8,000 and we received $5,000 of it. What accounts are affected? We got $5,000 of cash. Why did someone pay us $5,000 cash? Because they already owed it to us. We're not going to record revenue again. The revenue was recorded here. So we don't get another $5,000 here. That $5,000 is included already here. It just decreases what they owe us. This is earning the revenue. This is collecting money that's already owed to us from that revenue that we already earned. We paid $10,000 cash to settle the liability created in transaction C. So in transaction C, we bought equipment and we were going to pay for it later. Now it's later. So what is the transaction? What accounts are affected when we pay money we already owe? Well, if we paid money, put minus 10,000 there. Technically, we're paying for the equipment, but we already recorded that we bought the equipment because we already have it. So we don't want to put 10,000 again here because we don't have additional equipment. We just decrease here because we are paying what we already owed. So this could also say in this particular case, received money on account or paid money on account. That means we're receiving or paying money that's already there, not new earnings or new expenses on account. And then the company paid $1,000 cash in dividends to the owner. So minus 1,000. I don't know why it says the sole shareholder because that doesn't matter. I don't know. And that is dividends. So go minus 1,000 there. Notice there are no transactions in retained earnings because again, this cannot be acquired. It has to be accumulated over time. And in a nutshell, that's what we do. We follow the money around. We need to know and update it as it happens. It does not help us to wait until the year is done and then say, oh, we better figure out how much, money we have at December 31st and I wonder how much revenue we earned all year. Let's record everything all at once so that we know how we did for the year. That's not helpful because we need to know how we're doing as we go so we can make adjustments as needed. And we can know if we're spending too much, we need to increase our sales. We're not charging enough because our prices went up. Now we have to raise prices, whatever the case is. We don't want surprises at the end of the year. It's like, gosh, if we had been keeping track of all of this all along, we probably could have done a little better. So as it happens, we update the account, update following the money around as it happens. So we always know at any time how much money is owed to us, how much cash we have, how much we owe. Okay. This could affect us later if we don't pay money that we owe. That could come back later as not being able to borrow money when we need it or not being able to get an account open and have to pay cash immediately. How much we earn versus how much we use. Expenses are the costs to earn revenue. Revenue is what we receive from selling our products or our services, whichever the case is. And the vast majority of transactions, with the exception of corrections of mistakes, or the month and year end closing process, which we'll do in chapter 3, is one of 4 things. We receive money, we pay money, we owe money, or we are owed. And again, except for errors, corrections of errors, and month-end procedures, which is the day-to-day transactions. Again, this month there's 31 days of doing this and 1 day of month-end stuff. And then there's always a what for. If we receive money, that's good, but there's always a reason. People are paying us money, there is usually a reason. Either we sold them a service or a merchandise, they owed it to us already. If we pay somebody money, again, there's a reason. It's the employees that worked for us, gave us their time, so we paid them for their time to help us out. We paid for the office space, we paid for equipment, we paid for stuff that we bought. There's always a reason. We paid money that we already owe. If we owe money or somebody owes us money, again, there's always a what for. And that's the other side of the transaction, because each time, look, received money, paid money, we owe money, received money, we are owed money, paid money, received money, paid money, paid money. But there's always a second side. Sometimes there's more than one. This was three accounts. That's fine. But there always has to be at least 2 in all of our transactions to keep them balanced, and because there's always a reason. Questions on the transactions, the accounting equation. The accounts will always be given to us. This is our chart of accounts, because every business is going to have different accounts. Obviously, a bookkeeping business is going to have different account needs than an auto manufacturer. So we can have as many accounts as we want. So that will be provided as the chart of accounts, but same 5 categories for every single company. It just fits everything a company does, no matter how huge they are, what they sell, how funny their trucks look. Now, the Tesla cars are pretty normal looking. Why do the trucks look so weird? That is just my personal opinion, that the trucks look kind of weird. Obviously not that of Tesla, because they made them, but in my humble opinion, look weird. I hear they're really nice, and inside they're really nice, but it's kind of hard to blend when you're driving one of those. It just looks like a giant refrigerator or a giant appliance, right? Because that's the stainless steel appliances we all have in our kitchens now. It looks like my giant refrigerator on wheels. Can you wash it normal? I don't know. Just run it through the car wash? Does it get all water spotty? I don't know. Do you have to use a special appliance, stainless steel appliance cleaner on it? I don't know. Oh no. If I was thinking of getting one, I'm not now. I wasn't though, because I think they're really expensive. Questions? Now, the last thing we want to know, we did all of our transactions for the month of June. Let's first of all see what we're left with at the end of June, and just double check we made sure with each transaction that our equation stayed in balance. Let's make sure at the end of the month that we're still in balance, because that is always the case. If we are not in balance, if that equation does not balance, close enough counts, right? Close enough does not count. It has to be exact. It means there is a mistake somewhere if our counting equation does not balance. So I get 46,000 in cash. We still have 3,000 owed to us from customers. We did have 8,000, then we received 5 of it. We have 31,000 in equipment. We invested 15,000, then we bought 10,000 on account, and then we bought 6,000 more for cash. So we have 31. There's the equal sign. Well, as of the end of June, we owe $0, right? We owe 10,000, but then we paid it. We have a total investment of 75,000 in common stock. We have no retained earnings yet because a new company, it says she just started her company at the beginning of June. We cannot acquire retained earnings. It has to be accumulated over time. Paid out 1,000 in dividends. Earned a total of 10,500 in revenue. And then overall, we're going to subtract the total. The increases went up, but the expenses went up, but as the expenses go up, the total equity goes down. So we're going to add these up, but then subtract it from the total. So that's 4,500. Now let's see, does the left side equal the right side? I get 80,000 on the left and 80,000 on the right of the equal sign. So we do well. As far as this goes, that's kind of all that this tells us. This is just the detail of following the money around, increasing and decreasing the accounts so that we always know where it went and where it came from, because we can answer that again. The owner comes over, looking over our shoulder and says, what did we get that $2,500 for? Again, don't ever want to answer anybody's questions about our accounting records with, I don't know. Well, oh, that was revenue. And maybe they could say, oh, well, what job was that? Who did we sell that to? We should have the document to back that up, right? So that we can answer any questions to know exactly what services we provided to earn that 2,500, when it was provided, who we provided it to, and that it was paid in cash. So that we always have that detail. We're not going to show this to anyone. This stays in our office. This is for us. All we will do is just report out the totals at the end on the financial statement. Questions? Our financial statements are basically the same with one name change and one addition down here at the bottom. There are technically 4 required financial statements that have to be prepared in every annual report. Every time we do financial statements, the income statement, what used to be the statement of owner's equity, is now the statement of retained earnings, now that we are a corporation, balance sheet, and the statement of cash flow. The statement of cash flows we have not talked about as of yet, and we will not until we get to chapter 12, because it has a whole chapter devoted to how to prepare the statement of cash flows. So I don't think that it's fair to try to cram a little bit of introduction here into chapter 1 and then not see it again until we get to chapter 12. So we're going to pretend like it doesn't exist till we get to chapter 12. Now, mind you, we're out of order. Chapter 12 will be at the end of test 3. Test 3 is chapters 7, 8, and 12. So we will do this, but once we get to chapter 12. If it has a whole chapter, it's not, briefly introducing it here is not going to do it justice. We'll wait till we get to chapter 12. But the other 3 statements are the same. What goes on the income statement? Our income statement reports revenues minus expenses equals net income. If we earn more than we use, it is net income. If we use more than we earn, it is net loss. Everything that we earned, subtract out the amounts that we had to pay in order to earn that, because there's always expenses, there's always costs associated with earning our revenue. The overall objective of businesses is to maximize revenue, minimize expenses. That does not always happen, but that is our objective. So we want to know if we earned more or used more. 2 accounts only on the income statement. Statement of retained earnings is how the effect of the transactions for the time period, for the accounting period, whether it's a month, it's a quarter, or it's the year, whatever the time period is, how that affected our equity. And what was likely to happen, well, in the best case scenario, the textbook example, shall we say, is we get one influx of capital stock. We get one investment to get us going. And then in a perfect world, in the best case scenario, the company generates enough revenue to keep itself going. That's not always the case, and sometimes we may require additional investments or for expansions or for new product lines or for at some time we may require additional investments. But again, in the Hallmark movie version of accounting, we get one investment of either cash or equipment, it's a stock, to get us going, and then our revenue generates and supports itself. So the common stock account shouldn't change very often, if that is the case, which is kind of the thinking. Even if it does change, it's not as a regular basis. It's probably not on a monthly basis. If we are needing monthly infusions of cash through investment, then we need to rethink our business model. So this will not change regularly, I should say. It is possible that we need more investment in our business, but not as a regular course of business. This, however, is the accumulated earnings. This will change every year. Whether it increases or decreases depends on how we did, but this will change every year with how the company performed that year, because it's based on our revenues, expenses, and dividends. So we're not going to report the changes in the total equity, just in the earned equity. So we'll start with beginning retained earnings. And 3 things affect our equity: increases with revenue, decreases with expense, decreases with owner withdrawals, which are dividends. So those are the 3 things that are going to affect our equity over the normal operations of the business. Well, we've already calculated here the result of the increase from revenue, decrease from expense. So we're just going to bring this number down and say plus beginning plus net income or minus net loss, if that's the case, which is the net result of increase in revenues, decrease in expenses. We're going to subtract out any dividends paid, which are direct disbursements of the equity of the corporation to the stockholders, who are the owners. And then we're going to get ending retained earnings. Should look fairly familiar because when we were a sole proprietor, it was beginning capital plus net income minus drawing is ending capital. And so now that we're a corporation, we changed the names. It's beginning retained earnings because our invested equity is separate, plus net income minus dividends because it's name change equals ending. So how did the results of the operations for the time period affect our equity? And then our balance sheet is our fundamental accounting equation. Assets equals liabilities plus equity. So this amount will be included as part of the equity. We will list the two accounts. We will list here the common stock as the invested equity and the retained earnings, that is the earned equity. So as you see, these three statements take up all five categories. 1, 2, 3, 4, 5. So, well, these statements require just getting the balances of these various accounts and adding them up. This statement revolves around a little bit more in-depth analysis and takes some more calculations, which is why we'll talk about it. I will not ask you about nor ask you to complete a statement of cash flows until chapter 4. So if we go back to the next page, this is our financial statements page. Income statement, statement of retained earnings, balance sheet. And they made three different exercises out of this because you look on page 30 again. Exercise 118. It has all of these accounts and balances here. This is like our trial balance. Remember back from 100. So all of our assets, liability, here's equity, revenue, and expenses. And so instead of just saying do the financial statements, 18 says do the income statement. 19 says using 18, do the statement of retained earnings. And 20 says using the information from 18, do the balance sheet. So they just made three exercises out of one. So that's why it looks like we're doing three exercises, but it's the three financial statements. Income statement, statement of retained earnings, balance sheet, they do have to be prepared in that order because of the way the information flows forward. So we're going to put the account names here, details to the left, totals to the right in the formal financial statement. It just makes it easier to read, more broken apart when there's not always grid lines on the financial reports or the annual reports. So that's all. Once you get to Connect, if you're doing this for homework, it has the form set up with boxes of where you need to put the amount. So the format is kind of set up for you as far as the template in Connect, but on paper. We have to make our own format. Every report that we prepare, not just the financial statements, but every individual report will have a heading. We put the name of the company, which is Ernst Consulting. Name of the company, name of the statement. This first statement we prepare is the income statement. And the date, it says on December 1st, Jasmine Ernst organized Ernst Consulting. December 3rd is the investment in exchange for common stock to launch the business. And then this is December 31st. So it is only 1 month in this case, started in December 1st, and now it's December 31st. So our date will be for the month ended 12/31. The time period will make a huge difference when we are interpreting the statements to say, oh, how did we do? Once we get to these financial statements, these are external reports. So we have to be formal and label everything dollar signs so that there are no questions. I didn't put any dollar signs here whatsoever, nothing, because this is internal. I know it's dollars, but we don't know who may be looking at our financial statements. These go external to the company. So we do not want anyone misinterpreting or saying, I wonder what that's supposed to mean. So everything has to be labeled. Every dollar amount that we report has to have a description. And I emphasize that because when you get into Connect, if you get to the end of your financial statements and it just says answer is not complete, it's not very helpful because it doesn't tell you what's missing. If you can't figure it out, you can email me or Jill and we can see what it says. But once you get this net income figure, you have to write net income. Every dollar amount on the financial statement has to have a description. Because we don't know who is looking at these, and we do not know their background and familiarity with the reports to just assume they know what we meant. No, don't assume people know what we meant. We were going to tell them what we mean. So we're going to put a heading here and say, first, we are going to list our revenue, the heading. And if we look at our list of accounts, they are in what's called trial balance order, right? All of our assets, liability, equity, revenue, expense. We have one revenue account, consulting revenue for $14,000 for the month. So we'll put consulting revenue. Since we only have one source of income at this point, because there's only one revenue account, we don't have to put 14,000 total revenue, 14,000. We can jump straight to the total column and put our total revenue, dollar signs at the top of each column and at the double underline, putting it on every number tends to start looking crowded. So then we list expenses. We have 4 expenses. So we list them individually. Rent expense is $3,550. Salaries expense, $7,000. Telephone expense, $760. And miscellaneous, which we all know is donuts. 580. At least majority of it. So we're going to put a single underline because we're going to put the detail of the individual expenses in the left column and then put the total in the right-hand column. $11,890. Single underline because there's a total to follow. Put a single underline here. The total is over here. Put a single underline here because we're going to take our total revenues minus our expenses. Do we have net income or net loss? We have net income because we earned more than we used. So the difference is 2,110. And there's two underlines there. I'm going to make it more pronounced there. Dollar signs at the top of each column at the double underline. It looks too cluttered if we put it on every number. So just at the top of each column, every number, every amount has a label. So if you are Jasmine Ernst and this is your business, is this pretty good or pretty bad? Well, it's 1 month. It's our first month. So you got to figure it's going to take time to build up a reputation and a clientele. So for 1 month, our first month, I'd say that that's a win. We earned more than we used, which for brand new businesses is pretty good. But what if this said for the year ended? That's not good. So that makes a big difference in the interpretation part. So it's always a period of time on the income statement so that we know what amount of time that this total amount of revenue was earned. Since it's just 1 month, then okay, well, we're getting off to a decent start. Name of the company. The next statement is the statement of retained earnings. Used to be the statement of owner's equity. But now that we are a corporation, it is just the earned equity that we are looking at, always the same period of time as the income statement. We will start with beginning retained earnings, or we can put the date 12/1/14. Well, a new company will have 0 retained earnings. We cannot acquire retained earnings. We have to accumulate it over time. Whenever you have just a 0, again, blank is bad. Leaving stuff blank because then that makes people wonder, is that supposed to be blank? They forget something? Is that a glitch in the printer? What happened? But if we put a 0 with a line through it, that means no, it is meant to be 0. It is not just a 0. Is that all? Does the number not print or whatever? Putting a line through it means we meant that to be 0. And we'll put plus net income, and this number comes down from here. 2,110. Less dividends, because usually dividends are paid from the net income. So if we take the net income minus the dividends, that will give us what we retained or what we kept. We earned this much, but of that we paid out, and it says we paid 2,000 in dividends. So how much of the net earnings did we retain or did we keep? And that is
110.
net increase of 110 because the net income is an increase, the dividends are a decrease. Which gives us ending retained earnings or 1231.24 of 110. So our retained earnings went from 0 to 110 because of the operations of our first month of our business. Is that good or bad? Could be worse. Or as my mom would say, it's better than a poke in the eye with a sharp stick. Better than a negative. We could have paid out more in dividends out of the cash than what we had in net income, but we didn't. So an increase is always better than a decrease. So we'll take it. It's a start. Then our balance sheet is just one day on December 31st of 2024. We're going to report our fundamental accounting equation, just the balances on that day. So our assets, and they may have in Connect, I'm not sure, just one column, which is fine, or details and totals, I'm not sure, but just follow the format that's in Connect. 11,360 of cash. Accounts receivable of 14,000, which means all of our sales were on account because our revenue and our accounts receivable are the same amount. Office supplies of 3,250. Equipment of 18,000. And the one that always cracks me up, just a random piece of land for no apparent reason, just vacant land. But doesn't everybody just have this random vacant piece of land? It just cracks, I don't get it. You just have land. But it's an asset. The next account listed is accounts payable, which is not an asset. So let's total these up. $92,610. And double underline that. Details to the left, totals to the right, single underline total to follow, double underline, that's it, that's the answer. We double underlined, which means that's the only thing that's going in that question. Remember, the double underline means that's it, that's the answer. We're not doing anything additional to the statement. However, that is the left side of the fundamental accounting equation. We're not technically done with the statement, but we're not adding or subtracting anymore to that number. So then we're going to list our liabilities. We only have one, just accounts payable. Which we owe 8,500. There's only one liability, so we'll just go straight to the total column. And then our equity, however, is two accounts. We have our separate accounts for invested versus earned. So our common stock is 84,000 of invested equity. I didn't really need a dollar sign there. So. And then retained earnings is from here. The ending number as of December 31st is 110, which gives us total equity of 84,110. And then the right side of our fundamental accounting equation, total liabilities and equity. The liabilities plus the equity is $92,600. Has to agree. That's the balance sheet. Assets equals liabilities plus equity. Questions?
How did you come to the 92,610?
For the assets, it's the total of these, the total assets here. And then to get to this, it's the total of the liability of 8,500 plus that ending equity, which is the stock plus the retained earnings to get the total equity, and the 8,500 plus the 84,110 is 92,600. And then these two have to agree. Assets equals liabilities plus equity for our fundamental accounting equation.
Okay, I got it. Thank you.
And if those don't agree, close enough doesn't count, we did something wrong. We added something wrong or carried a number forward or forgot a number, because there's always a check figure that accounting equation has to balance. So if we don't, that means, okay, something's wrong, let's find it. And because mistakes happen, everyone will make mistakes. I will make mistakes up here. You will make mistakes on your homeworks. It just happens. But because of those extra built-in check figures and reviews and other people always having other eyes on our statements, that helps us catch the errors and fix them. And we'll get to that in chapter 6 too, because there's preventative practices and detective practices. So we have some things to try to prevent mistakes, but if they slip through the cracks, then we have ways to detect them and fix them. Questions? So this problem that's also in the template is in your outline, is similar to the homework problem for this chapter. There's actually, it shows 4 problems, but this is one of the problems that you're going to do 1-8A, which is similar setup. You're going to have your accounting equation with the accounts that you need, record the transactions for the time period, for the month. Let me look here. We're going to do 1-9B, but you're going to do 1-8A, so it's the similar format. And then that shows 3 other problems, but it's same as the exercise that we just did. It says 3, 4, and 5. Well, problem 3 has all of the data, all of the accounts and the balances, and it just says do the income statement. Then 4 says do the retained earnings statement. Then 5 says the balance. So it's one set of financial statements, but they made it 3 different problems. So it looks like there's 5 or 4 problems with homework, but this is technically one set of financial statements. So that's why it looks like there's 4 homework problems. I count 3, 4, and 5 as one problem because they're one set of financial statements. I would have done 1-9A, which is to do this column format and then do the financial statements of this information, which is what we're going to do. But they also threw the statement of cash flows in there, which I am not going to ask you to do until chapter 4. So this is on page 38 and 39. Starts on 38, finishes on 39, and it gives us the chart of accounts in the problem in Connect. This should already be set up for you for your homework problem. Have your accounting equation on the top and the different accounts that we will need. This case, we are a roofing company owned by Reina Rivera, but notice that doesn't matter as far as our accounts goes. We don't have Rivera Capital because we are a corporation, so it is generic common stock because it is completely separate business, rules, laws, tax return from the owner because we are a corporation now. There is no retained earnings account because, again, there's no activity in the retained earnings account. We have the investments in and then any dividends paid out. So it's minus dividends, payout will decrease equity, plus revenue, minus expenses, because as expenses go up, equity goes down. So here's our assets we need, our liability, just accounts payable, and then investments, invested equity, money paid out to the owner, revenues. So the first thing on July 1st, Reina Rivera invested $80,000 cash in the company in exchange for its common stock. What accounts are affected? Well, we again are doing the business account. So the business got $80,000 cash. And what for? It was the investment. So it was in exchange for $80,000 worth of common stock. We did not earn it. It's not revenue. It is not a liability. We do not have to pay it back. It is just an investment directly into the business. The company paid $700 cash for the July rent. So this is, sorry, I couldn't put that up there. July. It says we began operations in July. So this is our first month, obviously, because we have our initial investment there. And then we paid the rent for the month. Well, if we paid decrease to cash, what are we paying for? That is an expense. We're going to use that 700 of rent all within July. We're going to use it all up in 1 month. So it goes to expense, and if we want to be in that same office in August, we've got to pay again. We purchased roofing equipment for $5,000. We paid $1,000 in cash, and we agreed to pay the $4,000 balance in 30 days. What accounts are affected? The rule is every transaction has to affect at least 2 accounts. If we only affect 1 account, we won't be in balance. So it has to be at least 2. It can be more, but still needs to be in balance because, first of all, what did we buy? We purchased roofing equipment for $5,000. So here's an account called roofing equipment, which is different than office equipment. So we'll have roofing equipment of $5,000. And we paid for it with part cash, part on account. So we paid $1,000 right away. So we're going to minus $1,000 from cash, which means we're going to pay the rest later. We owe $4,000, so we go to accounts payable, and we owe $4,000. Here's the equal sign. We have 2 accounts on the left and 1 account on the right, but is our equation in balance? We have an increase of $4,000 on the right side of the equal sign. Plus 5 minus 1 is a $4,000 increase on the left side. So it does not matter your combination of accounts. We have 2 increases and a decrease. Here we had a decrease and an increase. Here we had 2 increases. It doesn't matter if we make sure and we follow this accounting equation and follow the money around with pluses and minuses, make sure that equation, it will balance every time. And if it doesn't, we did something wrong. The company purchased supplies for 600 cash. So, well, we paid 600, so we're going to put minus 600. So will that be an asset office supplies or will it be an expense? Well, it depends. What does it say? Because expenses have to be all or nothing, all used in July to go here. This was for 1 month, just for July. So that is going to be used all in July. Does it say that we used expenses as supplies or we bought supplies? It says we bought supplies. So we cannot assume we're going to use all of them. So since we don't really know, since the month isn't over yet, we're going to put it all in the asset first, and then any that we do use will move over to expense later. So we paid $600 for supplies, and we now have $600 worth of supplies, which some of which, maybe all, will be used in July, but we just don't know yet. The company completed work for a customer and immediately collected $7,600 cash for the work. Well, if we collected $7,600 cash, we're going to put plus $7,600 cash. What did that money result from? What did we get that money for? It says completed work past tense, which means we earned it, which is revenue. I'm kind of wondering how we put a roof on someone's house or business with only 5,000 of roofing equipment. It seems like there would be a lot more equipment involved in that. Just saying. Then we said, oh, well, we've got some money going around and some things we've got to keep track of. We better buy some computer equipment so that we can keep all of this, have some accounting software and keep all of this information and, you know, prepare purchase orders and invoices for customers and stuff. We need a computer. So we purchased 2,300 of office equipment on credit. So we bought a computer and a printer and a scanner and hopefully a desk and chairs and a file cabinet. I don't know, some office equipment. So we're going to say plus 2,300 because we have office equipment. And how did we pay for it? 2,300 of office equipment on credit. So we're going to pay later. So plus 2,300 in accounts payable. The company completed work for a customer on credit in the amount of 8,200. Well, completed work for a customer means we earned it. Already past tense, it's already done. We put that in revenue. And it doesn't say we got cash. It says on credit or on account means they're going to pay us later, which means they owe it to us, which is accounts receivable. On account or on credit will either be accounts receivable or payable. And again, it's receivable if later we're going to receive the money. It's payable if later we're going to pay them. We purchased another 3,100 of supplies on credit. Actually, that technically, I'm hoping that's like roofing supplies, right? You can't have that much in office supplies, I think. Probably need some supplies in order to remove and install roofs. So we bought some more supplies. So plus 3,100. How do we pay for it? It says we purchased 3,100 of supplies on credit. We're going to pay later. So we have more liabilities, increase accounts payable. On the 23rd, we paid 2,300 cash for the office equipment purchased on July 10th. So on the 10th, we created this liability for 2,300 for that office equipment that we purchased, and now we're going to pay this money that we owe. Well, if we pay the money that we owe, we decrease cash because we're paying, and we no longer owe the money, so we decrease the liability. We did not buy additional equipment, we're just paying for what we already purchased. We billed a customer $5,000 for work completed. The balance is due in 30 days. Well, work completed means we earned it, so that's revenue. And it says two different things. First, it says we billed the customer. It doesn't say that they paid us. And second, it says the balance is due in 30 days, which means we didn't get it yet. They're going to give it to us later, which is accounts receivable. These two transactions on the 15th and the 25th are the same. Look, increased revenue, increase accounts receivable, increased revenue, increase accounts receivable, but they're worded different. So, but that doesn't matter. Just break it down. Read what the transaction says, regardless of the words that they use or how, in what order they say it. It will always tell us what happened and if we paid now or later, or if somebody's going to pay us now. The company received 8,200 cash for the work completed on July 15th. So on July 15th, we completed this work. The customer owed us 8,200, and on the 28th, we received that money. No additional revenue was earned. We just received the money that is already owed to us. So plus in cash and minus, because if the customer paid us, they no longer owe us. We paid an assistant's salary of $1,560 cash for the month. So we had an assistant whose time we are paying for helping us out in July. So that is an expense. And we paid, so it's minus cash. We paid $295 cash for this month's utility bill. Since it was used during the current month, then it goes in expense. And we paid, so minus. And then we paid 1,800 cash in dividends. We paid cash, it's minus cash. And that amount was for dividends to the owner. Remember, as the dividends goes up, it's overall a decrease. So we decreased assets and we decreased equity by increasing dividends, equity decrease. And again, each transaction, received money, paid money, paid money, paid money, received money. We owe money. Somebody owes us money. We owe money. Paid money. Somebody owes us money. Received money, paid money, paid money. Every one of them is one of those four things because we're doing the monthly transactions, not the end of month transactions. During the month, it's always one of those four things. And there's always a what for. There's always another side of each of these of why we paid the money, why we received the money, why we owe the money, or why somebody owes us the money. Questions about the transactions? Then let's add up and see where we are at the end of the month and make sure that our accounting equation is still in balance. I get 87,545 in cash. $5,000 is still owed to us in accounts receivable. We received the 8,200, so we just have the 5,000 still owed to us. We have 3,700 in supplies, 2,300 in office equipment, and 5,000 in roofing equipment. There's our equal sign. We owe 7,100 in accounts payable. We have an investment of 80,000. We paid dividends of 1,800. We earned a total of $20,800 during the month. And in order to do that, we used expenses of 700 for the rent, 1,560 for paying our assistant, and 295 in utilities. $2,555 in expenses. Now let's just double check. I don't know if it's going to ask you to do this. Let's see if it asks you to do this in this homework problem. Oh, I think what they're going to do. Let me look, because I got to tell you this. Yeah. So I don't think the instructions are completely. I use pluses and minuses on each item. I think in Connect, you don't have to put a plus. I think you just put the number if it's a plus, but you have to put a minus if it's a minus. And I'm sorry, I could not take this out of Connect. I did not do it here, but what they want you to do is after every single transaction to retotal each column. So after this first transaction, which affected only 2 accounts, you're going to make totals. You're going to say 80,000, 0, 0, 0, 0, 0, 80,000, 0, 0, 0. And I'm sorry they have that in Connect and I could not take those out because if they were retotaling the equation every time, that would make more sense, but just retotaling the columns, I don't know. But so, and then after here, we'd have to then say, okay, now we have 84,300, 0, 0, 0, 0, 0, 80,000, 0, 0, 7. So that's what all of the, it'll say BAL after every date because they want you to put the balance in after every transaction. Sorry about that. But it does not ask us then to make sure the equation balances, but we're going to anyway. So put in the balances after every transaction, even if they're zero, right? Because you're going to have in this column 0, 0, 0, 0, all the way down till you get down to here. So let's total up all of our assets. I get a total of 103,545 for the left side of the equal sign and $103,545 on the left. That doesn't mean anything. That doesn't add up to anything. It just means our equation is in balance. What it does ask you on the homework, and you will have to answer this question, it says, determine the company's net income. Well, you're going to have different numbers because this is a different problem, but what is the net income? How do we get net income? Revenue minus expenses is net income. Well, our total revenue is, let's get the total. Again, you're going to have a different number, but it'll be the total of the revenue column minus expenses, the total of the expense column, 2,555, which gives us net income of 18,240. So there will probably just be a box. It'll say net income with just a box and then just type in the answer you get from the numbers from that problem. I think we'll do those problems next time. I'm going to look for a exercise that I think I want to emphasize. Again, no statement of cash flows. Might have to make it up. Let's see. Did it have? All right, I'll make it my own. I don't like that problem, so I'll make it my own. Hypothetically, if I was to ask a question on a quiz or a test that said something like, a corporation has retained earnings on January 1st of 68,240. Revenue for the year totaled, is there two L's in totaled? I don't know. So a corporation has retained earnings on January 1st of 68,240. Revenue for the year totaled 147,500. Expenses totaled 103,980. Dividends paid during the year were 25,000. What is ending retained? And I could give you on a quiz or a test a hypothetical one, a little statement, and ask you to prepare the statement, or just A, B, C, D with different amounts. What is ending retained earnings? Beginning retained earnings on January 1st is 68,240. That is given. We will add the net income subtract the expense, oh, sorry, nope, subtract the dividends, not the expenses. Subtract dividends to get ending retained earnings. Well, what is the net income? That was not given, but we can find it, right? How do you get net income? Revenue minus expenses minus 103,880. 43,520. Revenue minus expenses minus dividends of 25,000. Since the net income is an increase, dividends are a decrease, we net them together. So that would be a net increase of 18,520. So what we started with plus the increase would be 86,760. I just made this up off the top of my head, make sure I got my math correct. I think I did them in the calculator correctly. We're going to check again. So very, very similar to before, just name change. It would have been beginning capital plus net income minus drawing is ending capital. But now that we're a corporation, it's retained earnings and dividends instead of capital and drawing. What would the answer be? What would be ending retained earnings if instead, oops, everything else is the same, instead total expenses were 162 What would be our ending retained earnings? Only number that changed is just the total expense. Our beginning retained earnings would be 68,240. But now, instead of net income, what do we have? Because now our revenue is lower than the expense. Now we have minus net loss. Because now the expenses is higher than the revenue, it would cause a decrease. So we'd have 147,500 of revenue, but instead minus 162,500 of expenses, we would have a net loss of 15,000 and a decrease of dividends of 25,000 because that's the only thing that changed. Well, now both of these are a decrease. Here it was an increase, decrease. We netted it together. The increase was more. Here it's a decrease and a decrease. So now we have a total decrease of 40,000. Now parentheses in accounting mean minus. So what is ending retained earnings now? 28,240. This would be a net increase. This is a net decrease. Okay, one more what if, then we're done. So this is one, this is what if B, this is C. If total expenses were 129,250. Again, everything the same, beginning revenue and end dividends are the same, just the expenses change. Beginning retained earnings is still 68,240. But do we have net income or net loss? If our revenue is 147,500 and our expenses changed to 129,250, we still have net income, right? Because the revenue is less than the expenses. So we have net income of 18,250. And then dividends are still 25,000. But now what happens? We have a net increase or a net decrease? This will be an increase. Net income is more than expenses. This is a decrease, but now in our retained earnings statement, we did have net income, but the decrease from dividends is more than our increase from net income. So overall, retained earnings is going to decrease by the difference. So minus 25,000 is minus 6,750, a net decrease, even though we had net income because our dividends were less, and our ending retained earnings. $61,490. So just some different scenarios, which make very nice multiple choice questions. Remember, whenever I say that, it's because they did, likely that it would. to make a nice quiz or test multiple choice question to give you the components of the retained earnings statement and knowing the effect, but the calculations are the same. It just matters if our increase is more than the decrease, if there's two decreases, or if the increase is less than the decrease, because the dividends will always be a decrease. Dividends are paid out. But net income is an increase, net loss is a decrease. But is our net income more than the dividends or less than it? So that's the one that will change, is the net income. So, and I always recommend when you are taking a quiz or taking the test, have scratch paper. It should be blank when you start. But if you're reading a problem like this in a quiz, trying to put the numbers directly into the calculator, at least for me, from this paragraph form, I'm going to maybe have the beginning, and then NI and div, right? Very abbreviated so that I can get the numbers down and see it, as opposed to just trying to put the numbers directly in the calculator. That's when you can make mistakes a lot easier than if you're putting it down. That's why I always have scratch paper. I always write stuff out, because seeing it helps you look at it better, especially when you're in a situation like this. Oh, well, net income is an increase, dividends are a decrease, so this has to be an increase. Well, not in this case, because this minus is more than the plus. So seeing it, because it's not always an increase. Questions? Comments? We have one short problem, the financial statements for chapter 1 to finish up first thing on Tuesday, and then we will start chapter 2 on Tuesday. The chapter 2 gets into T accounts, journal entry, so there's a lot of forms in there that are helpful for us when we're working out the problem. So do suggest having that chapter outline, to also have your study guide and have all of the templates and forms already set up for the problems that we're going to work. Because this column format that we did, this is not an actual accounting form, and it's just introductory to remember it, so you can see all of the effects of the transaction. And it is very clear what happened, but this is not the actual way we're going to do that. The actual way any company does it is not this. So we will not see this after chapter 1. We're going to change the format a bit, but everything else is the same. What accounts are affected by how much, increase, decrease. It's just how we write it down will be different. Starting Tuesday, if you're not already registered in Connect, please try to get that done before too much longer, so that you don't have any issues with doing any homework problems. Do not wait until the last minute. You have every right to do so, but that's the risk you take. So don't do that. Give yourself plenty of time, and then we can fix any issues should they come up. Have a great weekend, the last weekend of August, and I'll see you on Tuesday.
I have a question.